Good morning. In the last class, we have already discussed about the theory portions of independent branches. In case of independent branches, how reconciliation entries will be passed, then how transfer entries will be passed, and also the adjusting entries, profit and loss account of the branch, how it will be incorporated in the head office books, then incorporation of branch trial balance in the books of the head office. All these entries we have already discussed. Today, we will work out a problem on independent branch. This is the problem. Following is the trial balance of Cuttack branch as on 31st December 2015. Delhi head office account debit balance, then stock, purchases, goods received from head office, sales, goods supplied to head office, then you have got salaries, debtors, creditors, rent, sundry office expenses, cash at bank, furniture, depreciation and furniture. Stock at branch on 31st December, that the closing stock is given to be 7,700. Then Cuttack branch account in the head office books on 31st December 2015 stood at rupees 460 debit balance. Then on 28th December 2015, the head office towards forwarded some goods of the value of rupees 3,700 to the branch when they were received on 3rd January 2016. That means, by 31st December it has not been received. So, we can treat it as goods in transit. Then the instructions are: prepare trading and profit and loss account of Cuttack branch for the year ended 31st December 2015 and the balance sheet as on that date. This is the first task. The second one is show Cuttack branch account as it would be closed in the books of the head office. Then also you have to prepare the ledger account in the books of the branch, what will be the head office account. In this way, we will be preparing one trading and profit and loss account, this is Cuttack branch trading and profit and loss account. And also the balance sheet we can prepare here. So, we will be preparing Cuttack branch trading and profit and loss account. Then we can prepare one balance sheet. Let us write balance sheet of Cuttack branch as on 31st December 2015. These are the liabilities and assets. Amount in rupees. Similarly, we can also prepare the head office account in the books of the branch and also the branch account in the books of the head office. First of all, Delhi head office account is showing a debit balance in the books of the branch at rupees 3240. This 3240 will appear in the head office account. It is showing two balance brought down, two balance brought down 3240. Stock on 1st January 2015, we can call it opening stock, and the opening stock is 6000. Opening stock will appear in the trading account. So, 2 opening stock, $6,000. Purchases 97,800, that is also a trading account item, 97,800 to purchases. Next one is goods received from head office 19,000, but actually goods supplied to head office 6,000, that is the return. So, goods received from head office 19,000 in addition to the purchases. So, 19,000 we can write to goods received from head office. Goods supplied to head office, sales 1,38,000, by sales 1,38,000. Sales 1,38,000, then goods supplied to head office 6,000. That means goods returned by the branch to the head office 6,000. So, by goods returned to head office 6,000. Next item is salaries rupees 4,500. Salaries will be indirect expenses, we can write it here, 2 salaries $4,500. Debtors. So, in the balance sheet debtors will appear at rupees 3,700. Similarly, the creditors are 1,850, which we can write here in the liability side, creditors 1,850. Rent rupees 1,960 debit balance, to rent 1,960. Then we have got sundry office expenses 1,470, that is sundry expenses to sundry office expenses 1,470. Next item is cash at bank 1,780. This is an asset. So, in the asset side cash at bank 1,780. Then furniture 6,000. Furniture also here it will be furniture 6,000. Depreciation on furniture 400. Depreciation furniture market, it is given in the trial balance. When it is given in the trial balance, it means the figures are adjusted figures. That means, this is if this would have been given, this depreciation would have been given in the adjustments, then that 400 rupees depreciation would have been deducted from this, that is the credit effect, and again 400 rupees here we would have written in the profit and loss account. But here it is given in the trial balance itself. Inside the trial balance, when it is given, it will have only one effect, because it is an adjusted figure. So, what we have to do is only one effect we have to give, whether debit or credit effect, that can be spelled out by the debit balance or credit balance as per the trial balance. In the trial balance, it is in the debit side. So, only one debit effect will be given. Where the debit effect will be given? We can write it here in the profit and loss account, to depreciation on furniture 600. Then stock at branch on 31st December 2015 was valued at 7,700, that is the closing stock. When closing stock is given in the adjustment, we have to give two effects, one debit and one credit. Here we are giving the credit effect by closing stock $7,700, and closing stock will appear here in the balance sheet. Asset side means debit effect, this is the debit effect, this will be the credit effect. Closing stock 7,700. There is a cash in transit, goods in transit. It is really Kotak branch account in the head office books on 31st December 2015 showed at rupees 460 debit balance. So, in the books of the head office, when we are preparing the branch account, it is showing a debit balance of, we can write two balance brought down, $460. On 28th December, that means 3 days before 31st December, when we are going to close the accounts, on 28th December 2015, the head office forwarded goods of the value of 3,700 to the branch, where they were received on 3rd January 2016. That means, within 31st December, the branch has not yet received, means it is a goods in transit. Now, for goods in transit, or for that purpose you can say cash in transit, only one party will have to pass the entry, either the head office will pass the entry or the branch will pass the entry. The entry will be goods in transit account debited to other party's account. Now, if the branch passes this entry for 3,700, the entry will be head office account debited to goods in transit. 3,700, and goods in transit will appear again in the asset side of the balance sheet. $3,700. That means, we have the closing stock of goods in hand 7,700, again goods in transit are 3,700. In this way, the total closing stock will comprise of two elements, one is stock in hand, another is stock in transit 3,700. Then the head office will be credited, actually the entry is goods in transit account debited to head office account. So, head office account will be credited by goods in transit. $3,700. This is the credit effect, and when we are keeping it in the asset side of the balance sheet, it is the debit effect. So, the double entry is being completed. Now, let us come to know what are the other elements to be recorded in the trading account, profit and loss account and balance sheet. First of all, we have taken opening stock, we have taken purchases, we have taken goods received from head office. These three items we have taken, and in the credit side we have taken 1,38,000 sales, goods returned to head office 6,000 and closing stock 7,700. Then we will close this and find out the gross profit. This is coming to 700, 1,51,700. 1,51,700. So, to gross profit carried down, the balancing figure we have to calculate, that is 900. This is coming to 28,900. So, by gross profit brought down, 28,900. Then we can find out the net profit. After deducting the total of these 4 items, 600, 4,500, 1,960 and 1,470, how much we are getting? That will be our net profit, 28,900. All the items which will now come across will have two effects. Here it is the debit effect, here it is the credit effect. Similarly, when we are getting the net profit, $28,900 to net profit this is 0, this is coming to 13, 1, 1, 4, 5, 15, 20, we have missed one. Depreciation on furniture is how much? Depreciation on furniture is 400. I am sorry, this is depreciation on furniture is 400. So, it will be 330 total. From 28,900, if we deduct 28,330, we get 075. So, it will be 570. So, in this way it will be 570. We are deducting 20,000 . This total is up to this we will do 0. So, it will be 20,570. Here we have written 20,570. This is the net profit. Once you get the net profit, automatically the head office account will be credited with this amount of net profit. That is, by profit and loss account, within bracket net profit, 20,570. The branch will write like this: head office account is credited by profit and loss account 20,570. If you remember, we have passed the entry when we are discussing different types of entry, whenever there is net profit of the branch, in the books of the branch, it will be transferred to head office profit and loss account or head office account first of all. So, head office account is created by profit and loss account. Now, in the books of the head office, what they will do? For this, they will make responsible the branch, and the branch account will be debited to net profit or to general profit and loss account $20,570. In this way, we will be showing it in both the places. This is the double entry completed. This is in the debit side, this is the credit side. But coming to the head office books, they will also write branch account debited to general profit and loss account 20,570 for the amount of profit earned by the branch. Then we will come to close the head office account. $24,270. So, two balance carried down zero 3 0 21 21,030. So, if it will be two balance carried down, it will be by balance brought down. $21,030. If that is 21,030, then it should appear in the asset side of the balance sheet. The head office account is showing a debit balance of 21,030. So, in the balance sheet that account should be there. So, the head office should get a credit balance of 21,030 means he is a liability. So, head office account 21,030. Now, coming to this one, let us close the branch account in the books of the head office and whether the balance is coming to be same or not. It should be same, but in the opposite direction. Let us see whether it is coming or not. The total comes to 0 21,030. So, if we write 21,030 here, it will be by balance carried down 21,030, two balance brought down in the next year opening 21,030. So, here you can mark and be satisfied that both the balances agree, that is the head office account balance in the branch books and the branch account balance in the head office should be equal. So far as the figures, numerical figures are concerned, they should be equal, but in opposite direction. Here you can see head office account is showing a credit balance of 21,030 and branch account is showing a debit balance of 21,030. That means our problem is correct. The reconciliation has already been made and these two balances agree. Now, there is no work excepting totaling the balance sheet. If the balance sheet total is tallying, then we can be assured that our problem is correct. This side is coming to 22,880, 22,880. And this one 80, 880, 22. So, both the sides total are the same. So, this is the problem. You should be satisfied that your balance sheet is coming exactly same in both the sides. This branch account in the books of the head office is showing a debit balance of 21,000, while the head office account in the books of the branch is also showing 21,030, but in the credit side. So, that is the proof that our problem is correct. So, this is all regarding your independent branches. So, all the home branches we have already completed. Number 1, we have done debtor system, then we have done final account system, then we have done your wholesale branch system, then we have done this stock and debtor system. These are the 4 methods we have used for the dependent branches and one method that is for independent branches. Now, independent branches and dependent branches both are under home branch. Now, coming to the next type of branch, that is foreign branch. We will be doing now the foreign branch and the accounting in the case of foreign branch. When the head office is situated in another country, that is not in the country where the head office, the head office is suppose in one country and the branch is in some other country, then that branch will be called a foreign branch. In case of foreign branch, you should always remember that it is one independent branch. It cannot be a dependent branch. A foreign branch necessarily is an independent branch. So, all the methods which we have used for independent branches, that will be also used here. In addition to that, we have to just do one thing, one extra thing. What is that? That is the conversion or translation of the branch trial balance items in the books of the head office, because in the branch trial balance all the figures must have been shown as per their currency. Suppose we in India are having the head office is in India, head office is in India, but the branch is somewhere else. Suppose the branch is in Singapore. There they have got dollars, Singapore dollars of course, and here in India we have got rupees. So, when they prepare their trial balance, the Singapore branch must have done it according to the dollars. Now, dollars have got an exchange value. We have to convert these items expressed in terms of dollars to Indian rupees while preparing the head office accounts. So, in the books of the head office, the first task is to convert all the items appearing in the branch trial balance to Indian rupees. For that, that incorporation of the foreign branch trial balance will have to be done using appropriate exchange rates. What is this appropriate exchange rate will be our subject matter of discussion. This appropriate exchange rate may be a fixed rate or a fluctuating rate or different rates, because we are doing for 1 year. In 1 year several times the exchange rate must have been fluctuated. In the opening date, whatever was the rate of exchange might not be the same at the end of the year, or during the year also it may have or it might have changed several times. Therefore, it is our first duty to convert all the items appearing in the branch trial balance to Indian rupees by applying appropriate exchange rates. If there is only one fixed rate, fixed fluctuating rate, fixed exchange rate, then there would have been no difficulty. But because it has to be converted at different rates, there will be some differences. There what will happen? The exchange rate when becomes different, naturally the debit side and the credit side of the trial balance although agree according to the Singapore dollars, but in India when it has been expressed in terms of rupees, there will be a difference. Either there will be a difference in the debit side of the trading account, sorry, the debit side of the trial balance, or in the credit side of the trial balance. So, accordingly we have to fill up that, and that will have to be filled up by difference in exchange account. The account name is different in exchange account. Suppose the trial balance is coming to, when converted to rupees, suppose this total is coming to 50,000 rupees and this is coming to 51,000. That means, we have to write it like this: 51,000 is the larger total. So, we can write 1,000 here, and that is nothing but difference in exchange account. We can attribute this 1,000 of difference, which is our in the debit side it is falling short by 1,000, we can keep it 1,000 difference in exchange account. Then our balance sheet will tally and we can take this into the asset side, because this is a debit side item, it will be going to the asset side of the balance sheet. If on the other hand it would have appeared here in the credit side, it would have gone to the balance sheet liability side. So, that is the last thing. But now the real difficulty is, what are the different rates, whether the rate is almost same throughout the year, that means almost same in the sense there is no much of fluctuations. So, we will be doing it under two methods or two circumstances, that is, first of all, rules for conversion of branch trial balance when exchange rates are stable. Rules for conversion of branch trial balance when exchange rates are stable. When exchange rates are stable, a fixed rate of exchange can be used for all items excepting one or two items. For almost all the items, a fixed rate, the first thing is a fixed rate will be fixed rate of exchange will be applicable for all items except the followings. So, all the items will be converted according to the fixed rate of exchange excepting number 1, remittances. The branch must have remitted some money to the head office from time to time. So, which rate will be applicable? Actually, it is to be converted at the actual rates at which they are made. At actual rates on the date of remittance. if suppose on 1st July an amount of $5,000 have been sent by the branch to the head office, $5,000 have been sent on that date, that is on 1st July, and on 1st July suppose the exchange rate was $1 is equal to 30 rupees, Singapore dollars, it is not USA dollars, suppose 30 rupees. So, $5,000 means 5,000 into 30, in terms of rupees it will be 1,50,000. But again on suppose October 31st, again some 5,000 or say $10,000 have been sent, has been remitted by the branch to the head office. Now, on that date suppose $1 was 35 rupees. So, it will be rupees 10,000 into 35, because on that date it was 35 rupees per dollar. So, it will be 3,50,000. We cannot apply either 30 or 35 in both the cases. On the date of remittance, what is the rate? The actual rate of exchange will have to be applied, and we will be knowing what is the total amount of remittances in or received by the head office from time to time. Like this it will be converted. Then the second thing is head office current account, that is head office account. In the books of the branch there will be one head office current account, and in the books of the head office there is again branch current account. So, the actual figure shown for the branch account, branch current account in the books of the head office will be shown by the for this head office So, for the head office current account, what should be the exchange rate? Actually, the exchange rate will be the actual figure shown the actual figures, no exchange rate is required, the actual figures shown for the branch the actual figure shown for the branch current account in the books of the head office. So, no rate is applicable, only the actual figures shown for the branch current account in the books of head office, whatever it was there, that will be repeated or that will hold good. But here you have to do one thing, that is the transit items after making adjustments for goods in transit and cash in transit. So, these are the two transit items which are possible, and suppose when goods are sent by the head office is 8,000. Out of 8,000, suppose 3,000 rupees worth of goods are in transit. So, for 5,000 we will be making the record. After adjusting the transit items, you have to record the figures, and those figures which are appearing in the branch current account, that will hold good in the books of the head office. So, this is the two things which you have to remember, that is when exchange rates are stable. First of all, a fixed rate of exchange will be applicable to all the other transactions excepting two transactions or two items, that is remittances. Remittances will have to be at actual rates on the date of remittance, whatever was there, that we have taken through the example, and the head office current account, that balances will have to be shown at the actual figures which are shown in the branch current account in the books of the head office. Of course, after making the adjustments for your goods in transit and cash in transit. So, this is in the first case when exchange rates are stable. Now, when exchange rates are not stable, so many times it fluctuates. What do we have to do? When exchange rates are fluctuating, then we can go for a series of exchange rates. For different types of items, there will be different exchange rates. Number 2, when exchange rates are fluctuating. So, for different items, we will be having different rates. So, this is item and this is rates of exchange. So, first item is opening stock. Opening stock will have to be valued at the rate applicable on the opening date of the year. Suppose we are starting the year from 1st April 2017. So, on that date, what was the rate? The opening stock will be taken care of, or will be exchanged, or will be, you can say, converted according to that rate. So, the opening rate or the rate applicable on the date of opening. Similarly, the closing stock will be valued at the closing rate, or more scientifically telling, the rate which is the exchange rate which is applicable on the last date of the year, that will be applicable for valuation of the closing stock or conversion of closing stock figures. The third one is fixed assets. Fixed assets will be valued at a rate at the date of acquisition or on the date of remittance. As on the date of acquisition, that is acquisition of the asset, as on the date of acquisition of the asset, when this has been acquired, when the purchase of the fixed asset has been made, on that date what was the rate? That rate will be applicable to convert the fixed assets items. Or if the payment is not made on the same date, then on the date of payment, whatever rate was there, on the date of payment, whatever rate was there, that will be applicable. Similarly, coming to fixed liabilities. Long term liabilities. The rate which will be applicable on the date of incurring it, rate on the date of occurring. That means when the liabilities occurred, when we are incurring that loan, when we are taking that loan, or the whatever it may be, whatever credit items etc. are there long term. So, for the long term liabilities, on that date when we have taken the loan, what was the rate, that we have to see, and that we have to apply for converting it. That is number 4. Number 5 is current assets and current liabilities. Current assets and current liabilities. Because the current assets fluctuate very often throughout the year, so also the current liabilities. What we have to do is, we have to apply the closing rate. Excuse me. So, on the date of closing, what are the current assets and current liabilities you are taking? So, the closing rate or the date on the closing rate will be applicable for this. Number 6 will be revenue items. When we are telling revenue items include revenue income, revenue expenditure both. So, all the items of revenue income and revenue expenditures will have to be recorded at an average rate. What is the average rate? Because every week or every month these rates of exchange are fluctuating. So, if there are 10 rates or 12 rates or even 60 rates, those 50 or 60 rates will have to be totaled and then divided by 50 or 60, and we will be getting the average rate of exchange, and with the average rate of return, average rate of exchange, these revenue items will have to be converted. Then number 7 is depreciation. Depreciation on the fixed assets will have to be provided, and how that will be converted? That can be converted by the same rate which is applicable to the respective asset. So, rate applicable to the respective fixed assets, to the respective fixed asset. So, if the fixed asset is suppose furniture, what rate was there applied as on the date of acquisition, what was the rate? On that date or on that rate, according to that rate, with that rate you can find out the depreciation. If suppose plant and machinery was purchased on some other day and there is a different rate of exchange on that date, on that date whatever rate was there, that depreciation will be also calculated, converted according to that rate. Next item is remittances. We have already discussed remittances. Rate on the date of remittance. Whether the head office or the branch has sent a remittance on that date, whatever rate was applicable, that actual rate will hold good. Then head office current account. This will be same as we have discussed in the first situation, that is head office current account will be at that rate at actual figure, not rate, at actual figure at which shown for the branch account in the books of the head office. So, the same thing here will operate. So, these are the different exchange rates on which we have to convert it. Once you convert it, then the new balance, new trial balance will be prepared, and in that new trial balance, according to the converted figures in our own country currency, we can prepare one trial balance like this. Write all the credit side items like this and debit side items. suppose this is coming to 50,000 and this is coming to 51,000. So, there will be a gap of 1,000 here, so that it will be 51,000. This one is called fluctuation in the exchange rates, or we call it difference in exchange, difference in exchange account. And this difference in exchange account will be closed by one entry. What will be the entry? The entry will be like this. If it is showing a debit balance, then the entry will be profit and loss account debited or if you do not want to transfer it to the profit and loss account, you can transfer it to exchange reserve account debited. Another account opened specially for this, exchange reserve account debited to difference in exchange account, difference in exchange account. So, this will be the journal entry for this type of item, but if this item will be there, suppose this side is bigger, it is 1,51,000 or say 1 lakh, okay, 51,000, it is not there. Then in order to make it 51,000, 1 lakh rupees will be there in the difference in exchange account. The difference in exchange account will be in the credit side. So, in order to close this, it has to be debited. If it has to be debited, profit and loss account will be credited or exchange reserve account will be credited. Just the reverse, in case it is not appearing in the debit side, but in the credit side. So, with this we conclude this chapter, that is your foreign branch, and also the whole branch accounting we have completed. Thank you.